Getting rejected sucks, especially when it's unexplained or unfair or you just don't understand it, right? And I'm not just talking about dating. I'm talking about loans. Getting rejected for your home loan sucks, especially when you're trying to take control over your finances and your financial future, and you get something back which you don't quite understand. You don't know why they've said no to you. All you know is that you can't get that loan that's going to help you progress with your financial future. I'm Jordan, I'm from Mountway Finance. You guys are my mountaineers. Welcome to the Mountway Say. And today we're talking about why does your loan get rejected? What are the top reasons for it? And how can you combat that experience and come out with an approval? So let's get started. Okay guys, now before we get into this is a big topic, many things to cover. We're gonna have to do this over 2 videos, but just so you know what's to come, we're gonna first talk about the regulation in the banking market and why these rules exist. And then we're gonna talk about some of the reasons for potentially your loan being rejected. They include having a high loan to value ratio or low deposit, the type of income that you earn. Sometimes it could be your spending habits that are a problem. Then we also talk about your credit rating, the property type that you might be looking at, any life events that are coming up or happening right there during the application, credit cards, personal loans and car loans and how they affect your application, and silly things like weird transaction references and Sportsbet and stuff like that and how that affects your application. So let's get into it. Now, before we get into these reasons, let's just explain a little bit about the banking industry in Australia. So all banks, or most banks, by and large, take your deposits and re-lend those to people in the form of home loans, business loans, sometimes credit cards, personal loans, whatever. But the major Australian banks are involved primarily in lending to the home market. Now, because banks are taking your deposits and re-lending that money, the regulators are very cautious with how banks can lend that money. The major regulator in Australia is APRA for our banks, and they more or less set a series of guidelines which is reflected in their lending policies by and large. There's a little bit of variation between the banks, but by and large those policies reflect the guidelines set by the one regulator, APRA. Now, Australia is credited with having one of the most stable banking industries in the world, and read into that to mean that the regulation is very conservative. When APRA sets these rules, they have in mind what they consider to be a safe borrower and what that looks like. And generally what that translates to is someone who is great at savings, someone who brings lots of cash equity to the table, someone who has stable employment, often considered to be a job with another company, and someone who has a good credit background and doesn't dabble in credit cards and personal loans and those sorts of things. There's a mold that they consider, the regulator considers to be a good borrower. And because it's very conservative, it's often out of step with how society is moving. There are many more good borrowers who don't necessarily exhibit all of those categories. Unfortunately, the regulation, which informs the bank policies, isn't always up to speed with where society is moving. So let's get into these reasons. Reason number 1, and probably the biggest, high loan to value ratio. Once upon a time, you used to have to bring 30% deposit for any purchase. There was no lending without a 30% deposit. And that was revised over time as prices rose and people had to deal with the challenges of cost of living and whatnot, to 80%. And that was a standard for a very long time. And then slowly there was the introduction of over 80% lending. And what that means is the bank will provide you 80% of the money to purchase a house, but you need to provide 20% plus the stamp duty, plus additional costs that come with purchasing that property. So as this over 80% lending started to be introduced, it was considered higher risk, but there was allowances made, and they generally came in the form of increased policy restrictions. And so what happens is when you move into that category over 80%, and there's really 3 categories, 80 to 90%, 90 to 95%, and 95 to 98%. Each one of those is considered higher risk, and it sort of goes in a bit of a hockey stick curve, it's not just linear. So the pricing and the policy impact that you get as you move into those categories increases, and it's much more restrictive in those higher risk categories to get that loan. So if you've got, less than a 20% deposit, less than a 10% deposit, you'll find that there are more trips in the policies that will render your loan to be rejected. Whereas if you were bringing 20% to the table, you might actually get that loan approved. So that's one of the big issues, high loan to value ratio. How can you combat that? Well, look, good old fashioned savings, that's one of them. Gifts from family, family guarantees, although that's a little bit treacherous and there are a lot of rules around that. And yeah, sometimes it's a matter of like, if it's your first home, it's not always your forever home. I know that sounds like an old fogey just trying to give words of wisdom to young people, but seriously, you buy that house, things will happen, change jobs, change location, new kids, and that dream home might not be such a dream home anymore. You've got to look elsewhere. So, you know, sometimes you can just lower your expectations a little, take that smaller house. Once you're in that market, you've got a growing asset, an equity building asset, which can be used to roll into your next purchase. So a few things there, but one of the frequent things that people can do to get over the line quickly is to just lower their expectations a little bit. Okay, next reason. I mentioned conservative regulator policies, and this comes down to not qualifying based on affordability, right? So if you think you're earning a certain amount of income, you definitely are, but that's not the way the banks see it, right? They haircut many forms of income based on what they believe to be sort of conservative measures of what generally happens, the reliability of that income, you might say. A frequent one and quite normal across the entire industry is rent. If you've got a investment property and it's earning income as part of the servicing assessment that goes into that loan application, you can include that rent. But it's only 80% of that annual rental amount which goes into the application, and even less in some other circumstances, such as rent earned from a regional location. The reasons for that are varied and many, including you may have a vacancy that's hard to fill, right? But you only get 80% of your rent counted. Likewise, allowances, overtime, shift work, bonuses, varying forms of treatment between 70% recognition and 80% recognition. Some banks go further, but the point is, what you think you earn is not what the bank includes in the calculations for your affordability. What can you do about that? Okay, with your broker or with your bank, look at how far out you are on affordability terms and whether the income mix is really affecting that. If it is, you may consider trying to work towards a different type of employment. Frequently, for example, going from casual and moving on to full-time can actually give you a better loan assessment. If you've received lots of overtime, for example, you can probably work more overtime, or you can maybe try and transition onto more regular pay. These are big changes, not to be considered lightly, but they can improve your debt servicing capability. Okay, reason number 3, let's look at the other end of the spectrum. There's income and there's expenditure. And look, in my experience, this is frequently the one that takes people out. Okay, and there's a couple of things to sort of consume here. One is your own level of expenditure. I frequently hear, and you know, I'm quite sympathetic to the point of view, that when I get a loan, I will control my expenditure to make sure that loan is repaid. That is what many people say to me, and I trust their conviction that they make sure they pay their loans. That's really, really honourable, but the bank doesn't see it that way. If you walk into a loan application having just holidayed and partied and spent money on new furniture and all kinds of other sort of frivolous stuff, they will think that that is you all the time. And therefore your expenditure as that presents in the most recent history will carry into the loan application, notwithstanding your willingness to adapt and pay the loan. So that's one thing that is a problem. Now, unfortunately, you think, okay, well, I can be really frugal, I can budget, I can cut this down. It is true, that will improve your application. However, only to a limited extent. Unfortunately, full-blown frugality is not overly awarded in a loan application because the bank generally applies what they call a HEM, household expense measure, a statistical average of what a household that looks like you generally spends. So if you're 3 kids and 2 parents and you live in Perth, there is a household expense measure statistically that applies for you. And if you spend less than that, and it's proven you spend less than that, the bank will still apply that HEM, All right, so your frugality isn't awarded there. Certainly though, if you are not frugal and spending too much, you get penalised. So some awareness and some control of expenses is important, especially in the 3 to 6 months before you make a loan application. All right guys, that's all we have time for in part 1 of this video. We do have a part 2, and in part 2 we're going to cover off your credit score, the property type, life changes that may have occurred, credit card limits, and weird transaction references. It's a bit of a mystery, I'm sure you'll look forward to that one. So, encourage you to subscribe so you can be notified of the second part, and join us for the part 2.